Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. India's third quarter GDP growth data for FY24 is set to be released tomorrow. And the expectations are that there is a slowdown that this data is likely to reveal. Has India's economy actually slowed down? We have a different variety of opinions on the show today. Joining me today is Aditi Nayar, the Chief Economist at ICRA. We're also joined by Achala Jethmalani, Economist at RBL Bank. Welcome to both of you. Aditi, I start with you. In the data that we have, the poll, ICRA is at the lowest of 6% and Nomura is at the other end of the spectrum at 7.3%. So why do you give that number and what is the reason behind this kind of estimate?
Thanks, Siddharth. It's actually, I think it's a little rare for the range to be this wide in a non-crisis quarter. But I think what is happening is we're at a little bit of a cusp. So this is a turnaround kind of a quarter. In Q1 and Q2, our growth estimates were on the higher side, which is generally what turned out to be the case. Those two quarters had a very benign base effect that was propelling growth to a level above 7%. For Q3, firstly, in many of the sectors, that very supportive base has turned normal. And that's one of the optical reasons why growth is going to look slower in H2 as compared to H1. Then we have a few other things that we need to contend with. One, the monsoon turned out to be rather uneven, and that has implications for the kharif harvest, which hit the market in Q3, and also for rural demand. So that's one of the factors. Then when we look at the non-agricultural sectors, the IIP has indicated that volume growth was slower in Q3 as compared to Q2. That's another factor. When we look at the investment-related indicators, there are quite a few that are again indicating a slower growth in Q3 as compared to Q1 and Q2. And specifically, when we look at government spending, so we've looked at all the state governments for which the data is available and Government of India. And when we aggregate it, there is actually a completely flattish trend in Q3 YOY, whereas Q1 and Q2 saw double-digit growth. So there is a massive slowdown in the pace of growth of government spending in Q3 as compared to Q1 and Q2. And these are the reasons why we believe that the number is going to look much lower than what it was in the first half of the year. That doesn't mean that there is this massive broad-based sort of slowdown in momentum. Part of it is optical, part of it is the timing of government spending. As you would, the viewers would be aware, government is on a cash basis. So when we incur the expenditure, or rather when we book the expenditure, that is the quarter in which the activity is deemed to have happened. And sometimes timing mismatches of releasing spending can also lead to these kind of fluctuations as far as the overall expenditure growth is concerned in a quarterly manner.
Okay. Achala, I'm coming to you. What's the Q3 GDP number that you're working with? In fact, it's 6.51% from the poll that we have. Explain the rationale behind that number.
Yes, thanks, Siddharth. So from the two extreme spectrum, we are at somewhere in the middle at 6.5%. And the rationale behind that is, I do concur with Aditi when we talk about agriculture performance being slightly poorer in the quarter. But we still think that manufacturing growth and overall industry growth would drive the momentum in third quarter FY24 as well. In terms of industry growth, we are looking at about 8% kind of a figure. And even on the services front, although government spending will see some bit of slowdown in the third quarter, both in sequential as year-on-year terms. But when we are looking at financial services, for instance, we think that the momentum is must have continued in third quarter as well. So that's where we are at. We think the only drag this time around would be from the agriculture sector. From the demand side, we think that continued investments and also a slight improvement in consumption in the third quarter would keep the GDP number at 6.5%.
Okay. Aditi, what about private consumption? We saw, and you touched upon that. In fact, both of you have touched upon government spending. As far as private consumption is concerned, what do you expect the Q3 data will tell us?
So, private consumption remains really quite uneven. That's our sense that, first of all, rural is more cautious than urban. But even within urban, there is a lot of unevenness. There's high demand at the higher income end of the spectrum and for people who are just entering the workforce. But in the middle, what I'm calling middle income, middle age part of urban India, the sentiment and confidence levels don't seem to be matching up. Inflation seems to be a much bigger concern. Overall increase in prices over a period of time seem to be factors that this part of urban India is more concerned about. And another thing is there that even now we're tending to see demand being uneven across goods and services. So we still see much better volume growth coming in for services, particularly higher end services like aviation and overall the hospitality sector. And maybe the demand for manufactured goods still seems to be on the lower side. So private consumption, it could be a little bit better than what it was in the last couple of quarters. But overall, the sectoral impact of that will be rather uneven. Within the services sector, the way we are looking at it, we actually have better growth outcomes for the trade, hotel, transport, communication part of services. For the financial services sector, like Achala was just pointing out, we expect a flattish trend compared to the previous quarter. So we expect the growth to remain relatively stable for that subsegment of services. And the laggard, of course, will be the government spending part, which will drag down the public administration, defense, and other services component of the services sector.
Achala, taking that point forward about government expenditure, clearly in the subsequent quarter also, we will see some sort of muted government expenditure, and then in the first quarter of next year as well because of the election season. But what is the downstream impact as far as sectors are concerned due to lower government expenditure?
That's a good question. There's a lot of uncertainty, especially as we head into election. But we still think that government spending momentum is likely to continue because one is as we head into election, although the election date is around mid of April. But we could see some bit of spending happening from mid-March itself as the nation braces for the election period. So in the fourth quarter, we would still see the momentum continuing. But if we were to go by FY25 budget estimates for revenue on the revenue side, then it is a slightly flattish growth. So next year, I think it will have to be more driven by the private sector and, so to speak, less by government spending, which is why for next year of FY25, we are slightly less optimistic on the overall growth trajectory front. We stand at 6.5%. For example, RBI MPC estimate is at about 7%. So the nuances do indicate that even as Aditi mentioned, the government cash balance has sort of increased. So that also in a way is indicating that probably government is not spending as much. So the momentum could be slightly lower in the next few quarters is what is being factored in.
Okay, a slower momentum in the next few quarters. Aditi, I had external member of the Monetary Policy Committee, J.R. Verma, on the show with me just yesterday. The conversation was about his views in the most recent MPC meeting. The question to you is that the kind of growth momentum decline that we might see, will it be picked up at the RBI? Will they be concerned about it? Or even with, let's say, the numbers, and we'll see what comes out tomorrow, they will stay on the path of inflation control as a priority?
So, the kind of narrative which we've seen from the RBI and the MPC in the last two policy meetings has been that growth outcomes are looking quite good. We've kind of made a good headway on the inflation fight, but there are still a lot of uncertainties, and therefore we need to stay on the path of keeping inflation expectations anchored, and therefore rate cuts are not going to come in a hurry. Now, if tomorrow the growth forecast ends up being in the 6% handle, or let's say between 6 and 6.5% instead of closer to 7%, then I think it's still not going to be so far below potential GDP growth that could trigger a very quick rate cut. Inflation, particularly the impact of the next monsoon on food inflation outcomes, will still remain quite important. Our base case is that once we have some amount of information on how the monsoon is going to turn out, the best case scenario right now is that we could get a stance change by June and then a rate cut by August. So I'm not sure that even a 6% growth print tomorrow is going to necessarily advance these too much.
Achala, that very same question to you. Whatever be the data, how will the RBI and the MPC eventually read it?
Yes, I think the focus remains clearly on bringing inflation down. Professor Verma has indicated that the real rates are too high, and that could lead to slower growth rate in the next few quarters. But we still think that even if the GDP growth numbers are in the 6% handle, it may not move the needle at the MPC to talk for the rate cut talks to begin. It is too soon in the cycle to be looking at rate cuts, especially when even globally, although we may say that we are not so synced with global rate cycle, but even when you look at the overall global growth trajectory and the global rate cut cycle beginning, we still think that growth numbers may not be the driving factor, at least in the next couple of policy meetings, as much as the incoming inflation data prints will be important to watch out for.
Okay. Let's rewind to all the estimates that we have up on the screen, and I'll request my producers to bring up the poll that we have with ICRA at 6%, like I said at the start of the show, and Nomura at 7.3%. Take a look just to sort of show you how it's spread out from 6 to 7.3. Society General, Stand Chart, Bank of Baroda, Sunidhi Securities. We can move on from there, and you will see IDFC at the middle, RBL at 6.51%, just a notch above, HDFC at 6.6%, and as we go further, ICICI Bank at 6.7, CareEdge at 6.9, IndusInd 7, and Nomura, and of course SBI, the big daddy of Indian banking, at 6.8%. Aditi, I am coming to you again on that point. Just to elaborate it a bit more, given what is likely to happen, and there seems to be a broad consensus around it, when do you think a rate cut is possible?
So, looking at where we see the global central banks starting to take rate cut decisions and our own inflation factors, we think that August is possibly the earliest that we can expect a rate cut. What will make it sooner than that? If the May 31st GDP print, which we will get for Q4, really surprises on the downside, that could lead to an earlier rate cut in June. Or if we have an early indication of El Nino turning to La Nina and the monsoon expectations being extremely favorable, that is something that could lead to an earlier rate cut. But, both of these are a little unlikely because you'll have to have a stance change, at least one policy, before the rate cut actually happens. So these factors will not manifest before the April policy meeting. So it's very unlikely that we'll end up with a stance change in April and then a rate cut in June. Much more likely that we'll end up with a stance change in June and a rate cut in August. And if, monsoon doesn't turn out like it's looking very good, or if growth surprises on the upside, then perhaps we could even see both of these getting delayed by a policy each to August and October.
Okay, June stance change, August rate cut, and depending on how it plays out, could get delayed. Aditi, what is the full year GDP growth estimate that you are working with? And obviously, with tomorrow's data, you might be able to update your forecast.
We're working with 6.5% for this fiscal, and at present, we're working with 6.2% for next fiscal because we expect government spending to be quite muted both during the election quarter, which will be Q1, and immediately after the budget is presented. Normally, we would expect capex to start picking up, but that's when the monsoon is going to be, at its peak in July, August. And therefore, we fear that capex will end up being quite back-ended in FY25. So we'll end up again with a tale of two halves. H1 is probably likely to report much more muted growth than H2. So we'll end up with a nice, back-ended pickup in growth in FY25. That's our base case right now. But these are all transient factors. I mean, I'm not saying that there is some big hit to potential GDP growth. These are transient reasons that are going to dampen growth in the next couple of quarters.
Achala, the point, and we will have a situation where in July a full budget will be presented. Do you think there will be any pressure, so to say, on the fiscal and administrative authority to respond to any growth decline? Or will it be that because the elections are behind and a big capex cycle is already underway, the government will continue on the trajectory that it has so far?
I think this is the outcome we would know, but we still retain our view that policy continuity is something that we can expect in the July budget as well. And interestingly, the focus in this budget has also been on capital spending being continued with about 17% growth compared to full fiscal FY24. So in that sense, we don't see such a compromise on the revenue and capital spending front. And therefore, we still think that the momentum, when you talk about the infrastructure-led or investment-led growth story for India to pan out in the next couple of years.
Aditi, how are you reading the global economic situation? We've seen various expectations, but it's clear that perhaps some of the worst is well behind us. What's your own reading?
Yeah, I would agree with that. Worst seems to be behind us. Geopolitics definitely remains something that we need to continue to watch out for, including, what happens in the Middle East, what turn the Russia-Ukraine situation takes. Even election outcomes in some, large geographies like the US would have some impact on sentiment. Red Sea situation. I mean, there are so many ifs and buts as far as the global economy is concerned. On the central bank action side, our broad view is that we're probably going to see rate cuts from the Fed after June, and 75 basis points seems to be appropriate for this year, not much more than that. So that's broadly the way that we're looking at, at least the kickoff of the rate cycle from the Fed panning out.
And our stock markets clearly putting a lot more store in that. Achala, China's deflation and the property bubble and debt worries, is that continuing to remain as a significant risk?
In global factors, yes, how the Chinese economy pans out in the next year would remain critical because a lot of government policy steps that the China government is indicating towards are more they're not exactly cash dolouts per se, which will boost consumption immediately. The kind of fiscal policy choices that we are seeing in the news indicate that there could be a slower growth recovery for the Chinese economy. And since it is the biggest, second biggest, largest economy, you would have to factor in how that could turn out for overall global growth and global performance.
Aditi, one final question. Is there a story for journalists like me and analysts like you to tell about the difference in optimism between consumers in some of the more advanced economies versus those in India? If you look at the premium end of the segment, it's like everything is on a fire sale the way things are flying off the shelf in India.
No, absolutely. I mean, when I talk to people in urban India, I get such varied responses in terms of how they are viewing their own spending power, their propensity to spend right now, their confidence levels in their own income growth going ahead. I mean, on one end, we have the wealth effect. The stock markets are doing so well, and certainly we can there are a lot of premium goods flying off the shelves, as you said. And at the middle income is where we feel that inflation is much more of a concern, and somehow sentiment seems to be a lot more subdued. Sectorally also, on one hand, we keep hearing about hiring being curtailed in the IT sector, for example, but that's not the case across all sectors. So I think it's a very mixed picture right now. But overall, when we look at the consumer sentiment surveys that come out from the RBI for urban India, the sentiment levels on average are very high, but I think they're concealing a much more nuanced picture.
Final question to you, Achala. If consumer confidence is high and the picture is pretty nuanced, that's a point that Aditi has made very well. What about business optimism and linking that to the revival of private expenditure?
The tough question has come to me, because private capex is something that everybody has been waiting for to really kick in. But when we look at the PMI numbers, which is a very survey-based indicator, and in that, when we look at the most recent reading, especially of manufacturing and services, at 56.7 and services at 61.8, is indicating that there is new order flow coming in and business optimism is on the higher side with input cost inflation coming down. So all these factors are very conducive for private sector investment to keep up the pace. When we look at the capacity utilization indicator, it is in the 74% handle, which is weaker than 75% seen in, say, in the years of 2019, but it is still better in the last several few quarters that we have seen. So I think we are right there. I think as long as the global growth continues, there's no major shock in terms of global risk, and our policy remains very conducive, I think it will just be a matter of time that we see private sector investments actually taking India's growth to a much higher level.
All right. Viewers, I was discussing this just the other day, that if just two of the major semiconductor investment plans that have been spoken about and are being worked upon, if they were to come true this year or maybe even the next year, those alone would make a significant dent to this story about where is private capital expenditure. But a lot of engines are firing, more need to do that. We'll wait for the fine print in the data that will be released tomorrow, and we'll come back with more data and analysis. Aditi and Achala, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.